Welcome back to the Mountain Morning Show. I'm joined by Travis McGhee from FuturesANIMal. How are you, my friend?
I am doing fantastic.
Yeah?
A little snow outside. It's great.
There is a little snow. That's nice to see the white stuff, don't you think?
Oh, yeah.
You ready to get out and get on it with some kind of a board underneath your feet?
I can't wait.
Yeah?
I can't wait. I'm stoked, yeah.
I'm kind of looking forward to it, too. I was enjoying summer, finally, at the end, when it cooled off a little. And then it was sort of weird. I didn't want it to go away.
It is, it is kind of sad.
Now I'm kind of like, fine.
Yeah.
Move on. I'm indoors so much now. I'm like, let it snow and rain.
Yeah.
And I'll get out there and ski on it as soon as it's all done.
Yeah.
Can't wait.
It's sad, but it's exciting. We're in that season now, full of tasty food. And,
this is a good point.
Football on TV and everything. It's great.
Right? There's football on all the time.
Yeah. You don't have to leave the house. It's great.
You got me convinced.
Yeah,
all right. I'm liking this. You know what else is? It's also a time of, which is kind of interesting, is a time when businesses start, typically to reassess their situation as the end of the real year comes up, depending on when their fiscal year is. That can be another time when they do this. But at the end of the year, we always tend to do this. And as people, we do it too. We start to think about what we're going to do next year, how we're going to do things differently. It's going to be a better year.
Yeah.
Things. And so as we get into that, sometimes we hope, especially when we come up to Christmas, consumer confidence is increasing. Interest rates typically, depending on which direction we're going with the consumer part of it, are up or down. But this year, things are a little different. And a lot of it has to do with how our government operated the last few months.
Right. Yeah. It's
expectations were to have a really, really big end of the year, and now maybe it's just a calm end of the year.
Yeah. There's certainly a aspect right now of uncertainty around what the end of the year is going to look like. A lot of that is because of the government shutdown, and certainly because we are moving into a period in January, February, where we're going to be going through these negotiations all over again. So
especially when they come back from only a week after their vacation, and they have 1 week to put it all together.
Right. Now,
good plan.
One thing for for people to understand is October is historically the most volatile month of the year in the stock market. We're almost at the end of October here, and it has been fairly volatile. And a lot of that is due to the point of some of the items that you mentioned earlier. Typically, it's the beginning of the fiscal year for most companies. Most companies are on a calendar where they start up in October. Kids are back to school, so families have the ability to kind of focus on their finances again, focus on their investments. You have a lot of things going on in the market where people are getting involved, and government's back at it, or they're back
or
at
not.
it, or not. So
a lot of financials that come in.
We're getting
and then you have earnings, kind of things
and
today.
then you have third quarter earnings that come out in October as well. So just a lot of stuff hitting the wire, and just creating I don't want to say hysteria, but there's a lot of hype going on in the media, in the newspapers, about the market and what's going on. And bottom line, I think it's going to be a great holiday season. I think it's going to be a great holiday season. I think numbers are going to come out better than expected. I'm still uncertain and cautious about the market. I mean, we're hitting all-time highs again yesterday in the S&P. It looks like we're going to...
The market was up this morning.
Up this morning on the futures. So looks like we could potentially hit all-time highs again today. I'm a little cautious on the broader market because I think we're getting a little ahead of ourselves as far as what's actually coming out in the earnings. And again, the uncertainty that we're going to hit heading into January. That's not to say I think you have people... And this is what's, in my opinion, is unneeded. Is you have people that are coming out saying, well, the market's due for a 50% retracement and this and that.
Oh, good grief.
And it just, it's unneeded hysteria and panic, especially for the retail investor. Again, folks like yourself, myself, that are managing their own money. Again, we've talked about it the past couple of weeks. You tend to make very emotional decisions. Rash decisions and change your portfolio based on what you're seeing in the news and everything.
Not a good plan.
It's not a good plan. I think, as an investor, stick to the plan that you have, remain disciplined, try and filter out all the noise that you're hearing and focus on what's important. And what's important right now, again, is the earnings that we're seeing, which are good. You know, we had Apple report yesterday.
Yeah.
You know, blew their
Great
earnings.
stuff.
Yeah, they blew their earnings out of the water. The profit margin was a little lower than expected, but the stock's up on that.
Still, it was the first time they've ever had one of their meetings where they came out of it with the stock going up.
Yeah, so
that's good.
So you know, there's been some decent earnings coming out. Again, we have what you were talking about. We have a low interest rate environment right now.
Well, that's kind of one of the interesting things to discuss is that we in the Fed we've got some changes happening, right? We're going to get a new Fed chairman. That's going to, you know, people are a little worried about that, but the truth of it is that we're probably going to have, we're getting someone who's going to stay the course.
Right.
And we're already seeing that they're going to stay the course. I mean, the last thing that anybody wants to do at this point is shut off the money flow, especially as volatile as things have been. So one can expect that things are going to stay. I mean, that's kind of the funny part about this, is you mentioned staying disciplined and not worrying about all these things. If there was any one group that does that really well, it's the Fed.
Yeah. So, and the Fed does that so that they're not, you know, mixing politics and monetary policy. You know, they're trying to remain neutral and you know, become unaffected.
Everything
of
they
everything
say
that's
does
going on,
something.
Political discourse that's going on.
Yeah.
But see, that's something that's important to understand. The reason we started these segments really was to kind of bring to light some important factors that's going on in the market that folks need to be aware of and try and filter out everything else. You know, the Fed is certainly one of those. And one question that we get asked by and large is, you know, when are interest rates going to go back up?
Yeah.
You know, and quite frankly, they're not going to go back up for the foreseeable future. As long as the Fed continues to buy $85 billion worth of longer dated bonds on a monthly basis, it's going to keep interest rates low. And that's going to impact your CDs. That's going to impact your money market, your savings account, any type of, you know, even mortgages to an extent. I mean, I know we had a pop in the mortgage rates when Ben Bernanke came out in the summer and said, hey, we might
We're going to start curtailing things,
tapering back.
Yeah.
This bond program, and interest rates just, you know, shot up to 4.5%. 4.5% on a relative basis is still very low as far as interest rates. So interest rates are going to remain low.
But they've settled back down too, haven't they? They've come back down to
they have come back down after September when the Federal Reserve, in fact, did not change the stimulus program, said, you know what, we're going to keep doing this for a little while. That's important to know as an investor because interest rates affect you as a consumer, as a saver. So you need to know where that interest market is and where it's going to be. I mean, most people right now on a 10-year CD are looking at just over 1%.
Yeah.
1%.
We thought 2 was really great.
Yeah.
That's hard to believe.
So,
because it was only, 8 years ago and we were getting 10.
Right. So 1%, if you think about that, and you have to look at it this way, 1% when you compare that to the rate of inflation, you know, that's almost a negative real interest rate, meaning, you know, take your percentage, subtract inflation from that, you're essentially, you know, losing money on that investment. So, you know, we have a lot of folks coming to us and saying, okay, so what do we do? Well, there's a lot of things you can do. Again, the stock market being one of those places that you could park some of your money in some of the larger companies, safer companies, you know, the GEs of the world, you know, some of the Pfizers and the
Coca-Cola,
you know, bigger companies that have a stable, solid dividend.
Yeah.
You know, some of these companies are yielding anywhere from 3 to 4%, and you know that's a great way to replace you know, some of that income. And then there are, again, some of the things that we've talked about, even in our own mock portfolio that you and I are doing, the demo portfolio, there are ways to use other instruments available to retail traders. Again, these are very easy instruments to use with a little bit of education to where you can generate income inside of your account, you know, again, anywhere from, you know, on a conservative fashion, you know, 2 to 5% a month. So,
do you are you one to also look sometimes at commodities and that end of the spectrum as well?
Sure. So we look at commodities quite a bit, and I look at commodities more from a, you know, to gauge supply demand, to gauge inflation, to gauge fear in the market, precious metals being one, what's going on with gold and silver,
right.
What's going on in oil. While I trade those and have some investments in those here and there.
That's the smallest part of
yeah,
the smaller part of your portfolio.
It's a smaller part of my portfolio.
Which it should be, because
Right.
they're high, they're extremely volatile, high risk. Anything could change, including the weather.
They are extremely volatile. Commodities are extremely volatile. The old saying is, on commodities, you take the stairs up, you take the elevator down. But it's a slow
That's
progression
an
higher,
way of looking at it.
and then all of a sudden it drops. But with that said, there's not to say that you can't have a portion of your portfolio, again, like we said,
Right.
Dissecting your portfolio and using some commodities, particularly precious metals, silver and gold, as a hedge and for protection. So if it really hits the fan in the stock market or something, or like some of these folks are saying, the market does pull back 50%, the thought would be that gold and silver will be worth more money.
So it's a good way to to hedge your bet, to level the playing field a little bit.
Right. But again, the important thing is, and like I was saying, the number one question we get asked is, understanding the bigger dynamics of the market right now. And interest rates are, I can't stress enough how important it is to understand what's going on with the interest rate environment, because that directly impacts you, again, both as a consumer and as an investor.
Well, let's talk about this part of it, because everybody, and I know you kind of alluded to this, everyone has some kind of a 401k,
right?
Typically, or something like that. They've got an IRA, they've got perhaps a Roth IRA or something. They've got stuff out there that, again, it's affected by this too, and they may or may not be looking at it. Many people just sort of set it and forget it.
Right.
That's kind of the attitude with this stuff. I'm going to buy what my company buys as a match, and I'm going to invest it, even a lot of times, and this is the scary one, right back in my company.
Right.
Might not be a good plan. But when we're talking about these things, sometimes people forget they're self-managed. You can do what you want with them. You can do other things.
And that's a great point. Now, for someone in their 30s or even their 40s for that matter, having something set aside and having your 401k pre-allocated where it goes into a certain fund every month, that's fine. That kind of is, set it and forget it. Now, you need to adjust the ratios over time, but you can certainly do that. But that's a great point. One thing investors need to understand is, in a lot of 401ks and certainly in IRAs, you can open an IRA with any brokerage firm,
right.
any online, E-Trade, Scottrade, Fidelity, any of the brokerage firms, and open an IRA or even transfer an old 401k over there and actively trade and manage that money yourself. And there, again, some of the strategies that we've talked about for generating income, educating yourself on the options market,
right.
educating yourself on the futures market, and some of these other alternative investments can help replace that income that you're losing in that CD, in that savings account, and generate income inside of that 401k and IRA, which you can do yourself.
Well, and this is especially important when we consider the different factors of investing, which is our own personal situations, which is age would certainly be one of them, right? If you're a younger person, leaving something just locked into a 401k and that leave it, forget it, set it, forget it idea is probably not as aggressive as you probably ought to be as a young person, right?
Well, it depends. I mean, again, it depends on what you're invested in. If you're 100% into equities and emerging markets,
well, then obviously this is your safe haven.
That's pretty aggressive.
Right.
So, you could certainly be aggressive, but there's no excuse, again, in my opinion, to not educate yourself above and beyond the basic concepts that are out there. Because all that's going to do is enable you to utilize some of these other tools that are made available to you for times like this, when the market is certainly from a savings standpoint and an interest rate standpoint is not producing the way you want it to produce. Certainly for the older generation.
Yeah.
And that's where we're seeing the largest influx of clients into our firm is the older generation. It's folks in their 60s, late 50s, 70s, who have primarily CDs and savings accounts, and they're not earning anything.
Right.
And they're like, they're coming to us saying, can you help?
Now what do I do?
What do I do now?
Right. Well, we have just a moment. Quickly, can you tell me where our investment is, our paper trade?
Yeah, so our paper trade, again, our demo account that you and I, and we for folks who are just watching today,
Yep.
we went out and did
We've
some
been
of these.
working on it for a while.
We have. We're 2 months into this. We went out and we've been playing a little bit with options and futures, and just some very conservative, high probability,
Right.
income generation type trades. So right now we're up on the capital that we've invested. Again, we didn't invest all of our capital.
Yeah.
We had a $100,000 portfolio.
Right.
We took a portion of that and put it into the market, and then we're up around just over 6% on the capital that we invested.
A fair return.
Yeah, in 2 months.
That's excellent.
And
Right.
yeah, so again, we had one trade that was a loser, but the other two have made money. So now we're reallocated for the month of November, and we'll see how this month
Sounds good.
plays out.
Travis McGhee, FuturesANIMal.
Yeah, thanks, Joe.
Appreciate it very much.
Yeah,
I hope
absolutely.
things continue on that trend. That's good.
Yeah.
All right, we'll be back in just a moment. Fashion coming up right after this.